Welcome to Breaking News to Trading Moves. Our focus here is taking information, looking at the key facts, and then assessing the immediate market responses. Specifically, we try to identify who benefits and who might be facing some new challenges.
And today we're looking at a very specific, I would say, strategic move in the pharmaceutical sector. It's all driven by a major acquisition, and it really involves Sanofi making a big commitment to the adult vaccine market. It's a calculated move that sets up their strategy for the next few years.
Absolutely. So this conversation is really centered on Sanofi's big financial commitment. It's a clear signal about where Big Pharma sees potential for, immediate revenue and also that longer-term pipeline opportunity. We're going to get into the financial mechanics of the deal, the vaccine assets involved, and what it all means for, three major categories of potential winners and three categories of players who are now facing some new headwinds.
Right. And we've designed this analysis to be, practical. We've sorted the consequences into these groups, the winners and the challenged, to give you a framework for how this one single acquisition affects the whole healthcare ecosystem.
Right.
We have to understand not just what Sanofi bought, but why they paid a premium for it. That tells us a lot about their future plans.
Okay, so let's start with the headline itself. The news was that Sanofi, ticker SNY, has agreed to acquire Dynavax, which is ticker DVAX. And this isn't just a standard transaction. It feels like a very focused injection of capital into a high-growth area.
It is. And the first thing to note is the structure. It's an all-cash acquisition. For a company the size of Sanofi, choosing cash is it's a statement.
What kind of statement? What does going all cash tell us?
Well, it streamlines the whole process. You avoid shareholder votes on equity dilution. But more than that, it just signals extreme confidence in the assets they're buying. When you put down $2.2 billion in cash, you're saying the return on this is going to be immediate and substantial enough to justify it. No hedging.
And the financial terms are pretty clear. Total value around $2.2 billion. And for anyone holding the stock, the tender price is $15.50 per share. That price is critical, right? It represents the premium Sanofi was willing to pay.
That $15.50 price is a new valuation marker for the whole vaccine space. It tells investors two things. First, having an approved revenue-generating product gives you immense leverage in these negotiations. And second, that specialized vaccine technologies, especially ones with advanced adjuvants, which Dynavax is known for, are highly valued by Big Pharma right now. The premium is for that commercial certainty.
Okay, what about the timeline? The report said the deal is expected to close in early 2026. That seems like a long way off. What sort of regulatory hurdles would push a timeline out that far?
Yeah, close date in early 2026 suggests they've built in a lot of time for some rigorous scrutiny. We're talking about bodies like the U.S. Federal Trade Commission, the FTC, and the European Commission.
And what are they looking for? Just competition in the hepatitis B market?
That's the main thing, yes. But increasingly, regulators are also looking at the concentration of specialized tech. Dynavax's adjuvant platform, the tech that enhances the immune response, is pretty unique. Regulators will want to assess if Sanofi owning that restricts innovation for competitors. That 18-month window is basically a buffer for any potential antitrust issues.
So Sanofi's stated goal is pretty clear. They want to strengthen their adult vaccine lineup. When we look at Dynavax, what are the specific assets that are worth $2.2 billion to them?
They're essentially buying a dual opportunity. Revenue now, and a foothold in a huge future market. The main asset for that immediate revenue is Heplisav-B.
Heplisav-B.
Right. This is Dynavax's marketed vaccine for hepatitis B. It's a known, successful product. It provides an immediate revenue stream that Sanofi can scale up exponentially with its global distribution network.
But hepatitis B vaccines have been around for a long time. What makes Heplisav-B so valuable to a giant like Sanofi?
It really boils down to differentiation. Heplisav-B uses that specialized Dynavax adjuvant system. And what that allows for is a full immunization schedule in just 2 doses over 1 month.
2 doses over 1 month, compared to what?
Compared to the standard 3-dose regimen that you see with legacy vaccines, like from GSK or Merck. That improved schedule translates directly into higher adherence rates with adults. And that gives it a superior commercial profile that Sanofi can leverage immediately.
Okay, so that covers the revenue now part. What about the future potential you mentioned?
Now, that potential is all wrapped up in Z1018. This is their early-stage candidate for the shingles vaccine category. This is what the investment world calls pipeline optionality. Sanofi isn't just buying current sales, they're buying an entry ticket into one of the most profitable vaccine markets in the world.
And the value of Z1018 is that it uses that same adjuvant technology.
Exactly. The same successful tech that powered Heplisav-B. That dramatically reduces the clinical risk compared to starting from scratch. It positions Sanofi to launch a competitive product in the future against the current market leader.
So if I'm putting this all together, Sanofi made a two-part investment. They get near-term revenue from Heplisav-B, and they've acquired this crucial pipeline optionality with Z1018, which gives them a credible way into the huge adult shingles market.
Precisely. They're using their cash to buy and establish commercial advantage and, at the same time, secure a spot in a long-term growth area. This acquisition positions Sanofi not just as a competitor, but as a future aggressor in adult immunization. And that changes the dynamics for everyone else in the space.
Which brings us to the bigger strategic question.
Mhm.
Why this intense focus on the adult vaccine market right now? Why is this area seen as such a growth battleground?
It really stems from a few converging factors. You have demographic realities, changing public health policy, and just pure commercial logistics. Unlike the pediatric market, which is pretty stable, often mandated for school, the adult market is highly elastic. Its growth depends on personal choice, doctor recommendations, and critically, how easy it is to get.
Right. So pharma companies aren't just selling the vaccine, they're selling adherence.
They're selling adherence, exactly.
Let's break down the commercial drivers. The first one is this need for differentiated schedules, which you touched on, making it easier for the patient.
Yeah, and differentiated schedules are a massive commercial advantage. Think about it. A vaccine that needs 3 doses over 6 months will have a much higher patient drop-off rate than one that's 2 doses in 1 month.
And that drop-off rate can be pretty high in adults.
It can exceed 30% in some cases. And every patient who doesn't complete the regimen is a lost revenue opportunity. Heplisav-B's 2-dose schedule basically guarantees a higher completion rate, which makes the revenue per patient much more predictable. Big Pharma will always pay a premium for that.
And that ties directly into the second driver, which is just a general focus on better adherence rates for adults.
Adherence is the engine for public health benefit and commercially for realizing full revenue. Adults are busy, they're juggling work, family, other health issues. The burden of scheduling multiple appointments is high. So companies that design products to increase adherence, fewer doses, faster efficacy, they're capturing a premium opportunity.
And the third major driver here is the existence of these large adult catch-up populations, people who just never got the standard recommended vaccines.
This is the demographic foundation for the whole market. The hepatitis B recommendation, for instance, has been broadened in the U.S. That creates millions of adults who were never vaccinated before but are now recommended to get it. Same for the aging population, constantly expanding the pool for shingles and RSV vaccines. Tapping into these catch-up groups represents a colossal demand floor for these vaccines.
So beyond just the volume, this deal also acts as a signal for broader market consolidation, doesn't it? What does a buyer like Sanofi paying a premium for a company like Dynavax, DVAX, imply for other biotechs?
Well, when a major player like Sanofi makes a $2.2 billion all-cash deal at a premium, it's like a bellwether. Investors immediately look at that valuation model-proof product plus quality pipeline, and they start applying that same lens to peers. It serves as a new benchmark for takeover value.
So it basically lifts the perceived valuation for other biotechs that have similar de-risked vaccine assets.
That's right. It fuels speculation, especially for those with advanced adjuvant or delivery tech. The market is basically saying, if you have a commercially validated product, Big Pharma is willing to pay for that certainty.
Okay, so what are the implications for competition? You mentioned incumbents in the shingles and hepatitis B markets should be getting ready for a tougher environment.
Absolutely. Sanofi is about to unleash its global commercial machine on this. When you bring Sanofi's scale, their existing contracts, their massive sales force, their logistics from things like the flu vaccine to bear, it just intensifies competition everywhere. They can plug Heplisav-B into existing contract bundles almost overnight.
So competitors have to respond proactively even before the deal closes.
Yes, they have to anticipate that Sanofi will push Heplisav-B aggressively in negotiations with pharmacy benefit managers or PBMs and large health systems. This forces competitors to rethink their own strategies. Maybe they offer bigger rebates or launch more aggressive marketing just to defend their market share. The whole equilibrium changes.
You also mentioned the role of policy, specifically the Advisory Committee on Immunization Practices, or ACIP. For our listeners who might not be familiar, can you explain why their recommendations are so critical?
ACIP is essentially the gatekeeper in the U.S. market. They determine if a vaccine goes from just being available to being broadly recommended and, crucially, reimbursable. When ACIP recommends routine use for a broad age group like they did for Hep B in adults, it does two things.
Okay, what are they?
First, it raises public awareness and drives physician prescribing. But second, and this is the financial part, it often triggers mandatory coverage by most insurance plans under the Affordable Care Act.
So an ACIP recommendation turns a voluntary purchase into a largely mandatory covered medical service for millions.
That's the commercial power of it. It removes the biggest barriers, cost and awareness. Sanofi's willingness to pay $2.2 billion is based on the confidence that both Heplisav-B and, down the line, Z1018 will get and keep these favorable ACIP recommendations that guarantees a stable, high-volume revenue stream.
For our listeners who are actively watching the markets, especially in the near term, the next, say, 1 to 6 weeks are key. We've identified 4 specific things observers should be monitoring.
The first, and this is most relevant for anyone holding this stock, is about Dynavax itself, DVAX. It involves tracking what we call the deal spread.
Okay, let's define that. What exactly is the deal spread in this context?
The deal spread is just the difference between Dynavax's current stock price and that $15.50 cash offer from Sanofi. If the stock is trading below $15.50, that gap, that spread, represents the market's calculation of risk that the deal might not close.
So if the stock is at, say, $15, that 50-cent spread is the market pricing in a small chance the deal fails or gets delayed.
Exactly. The narrower the spread, the more confident the market is that it'll go through smoothly. Merger arbitrage traders look for these spreads. And conversely, if that spread suddenly widens, if DVAX drops to $14, that's a huge red flag that a major regulatory hurdle has popped up. It's a real-time barometer of the deal's health.
Okay, the second watch item is the competitive response from the incumbents, the ones who stand to lose market share.
This is where the commercial battle begins, well before Sanofi even absorbs Dynavax. Observers need to watch the messaging, the pricing strategies, the promotions from the current market leaders in shingles and hepatitis B. We're looking for immediate defensive moves.
What would a defensive move look like, specifically?
You might see incumbents increasing their volume discounts to big buyers, like PBMs, trying to lock in contracts before Sanofi can bring Heplisav-B into their own bundles. Or maybe enhanced marketing campaigns that emphasize their product's real-world data and safety profile. In the shingles market, GSK will likely double down on the huge dataset they have for their product to counter any future claims Sanofi might make about Z1018.
Makes sense. Number 3 is watching for policy and demand signals, especially new commentary from the U.S. on vaccine recommendations.
Right. As we said, ACIP recommendations drive the market. So we need to watch for any new commentary that could affect volume. For example, if ACIP decides to recommend certain vaccines earlier in adulthood or expands the risk criteria for existing ones, that immediately expands the patient pool for Sanofi's new assets.
And this could also apply to general public health messaging, couldn't it? If the government starts emphasizing adult preventative care more, that also acts as a demand signal.
Absolutely. Endorsements from groups like the CDC that elevate the conversation around adult immunization that translates into more prescriptions from doctors. It's a rising tide for the whole adult vaccine sector, and it makes Sanofi's acquisition look even more well-timed.
And finally, the 4th item is to monitor the Sanofi narrative itself. That's ticker SNY. How are investors reacting to this strategic move?
Yeah, investor reaction is important because it dictates capital allocation. We need to see if the market rewards this adult vaccine expansion story. Do they see it as a smart, stable, revenue-focused move? Positive sentiment would suggest investors see this as good diversification away from areas where Sanofi might face patent cliffs or higher R&D risk.
But at the same time, you have to watch the broader pipeline sentiment for Sanofi.
That holistic view is essential. Sanofi is a huge, diverse company. While this Dynavax deal is good for their vaccine franchise, if they have a major setback elsewhere, say a phase 3 failure in oncology, that negative sentiment could easily overwhelm the positive reaction to this deal. You have to track the whole portfolio.
Okay, let's transition now to analyzing who stands to benefit from all this. Every major transaction creates some positive momentum for adjacent players.
We've broken this down into 3 categories of winners, starting with those who benefit from what's called the M&A read-through effect in the vaccine space.
Can you explain that? Why does a premium cash deal like this create winners in the M&A market?
It's all about asset pricing. By paying $2.2 billion in cash for a company with an approved product and a promising pipeline, Sanofi has effectively set a new price floor for similar assets. Investors will immediately re-rate other small and mid-cap vaccine developers that have similar validation or technology, assigning them a higher potential takeover value. The whole valuation paradigm for the sector gets an adjustment.
So investors are basically asking, if DVAX is worth this much, what should we value other companies with differentiated tech and similar milestones?
That's the exact mechanism, and this focus brings a couple of specific companies into the spotlight as potential M&A targets. We're thinking Novavax, ticker NVAX, and Vaxcyte, ticker PCVX.
Let's start with Novavax, NVAX. They have a proven vaccine platform, best known for their COVID-19 vaccine. How does this Sanofi deal help their outlook?
Novavax is a larger, more platform-centric opportunity. They don't just have one candidate. They have a proven protein-based technology that can be adapted across multiple diseases. The premium Sanofi paid for specialized capability and commercial readiness suggests that big buyers are looking for companies with proven tech they can just plug in. Novavax looks very attractive for any big pharma company looking to acquire a scalable platform.
And Vaxcyte, PCVX, they're more focused on next-generation conjugate vaccines, particularly for pneumococcal disease, which is a very competitive adult market.
Vaxcyte fits the mold because their whole strategy is about developing best-in-class products with clearly differentiated clinical profiles. Sanofi's move signals a willingness to pay a premium for high-quality candidates that offer better efficacy or convenience in these major adult categories. Vaxcyte's progress in their pneumococcal pipeline makes them a company that benefits a lot from this M&A valuation read-through.
Okay, the second category of winners you identified is the retail vaccination channels. This sounds more like a logistical benefit.
It is. It's purely a service revenue benefit.
The logic seems pretty straightforward. More promotion of adult vaccines means more vaccinations happening at pharmacies and clinics. How does that translate to the bottom line for retailers like CVS and Walgreens?
Well, these retail chains are relying more and more on high-margin services, not just selling things off the shelf. When Sanofi starts aggressively promoting Heplisav-B, that means more shots administered at the pharmacy counter. Every one of those shots is a billable medical service, reimbursed by insurance at pretty favorable rates.
And it also gets people into the store.
Exactly. It reinforces the pharmacy as a primary healthcare access point and generates secondary revenue from people buying other things while they're there. More adult vaccine volume is a direct positive for these companies.
And the two big names here are CVS Health, ticker CVS, and Walgreens Boots Alliance, ticker WBAA.
Right. CVS Health, with its huge national footprint and its integrated MyNet network, is perfectly positioned. Their whole infrastructure is designed for this kind of high-throughput, high-margin service. An aggressive campaign from Sanofi means a direct, immediate increase in profitable service volume for CVS locations everywhere.
And Walgreens, WBEA, they're in the same boat, relying heavily on pharmacy services as a core part of their business.
Walgreens competes head-to-head with CVS to be the go-to place for immunizations. A strengthening adult vaccine market, spurred by Sanofi's investment, translates directly into volume gains for WBA. It drives utilization of their core infrastructure.
All right, let's move to the third category of beneficiaries, the life science tools and bioprocess suppliers. This is looking upstream at the manufacturing side.
Yeah, this group benefits because successful vaccine programs require massive scaling. When production ramps up globally, you see a corresponding sustained increase in demand for specialized manufacturing support. It's a gold rush for the picks and shovels providers.
What kind of specific materials and services do they provide that see this increased demand?
We're talking about consumables, things that get used once and replaced. This includes highly specialized filtration equipment for purification, chromatography resins, single-use bioreactor bags. To scale up a vaccine like Heplisav-B globally, Sanofi needs to place orders for millions of dollars worth of these tools immediately.
So their revenue is tied to production volume, which insulates them from the commercial competition between the actual vaccine sellers.
Exactly. When Sanofi commits $2.2 billion and plans for aggressive global commercialization, it creates an almost immediate predictable revenue tailwind for these upstream suppliers.
The two companies named here are Thermo Fisher Scientific, ticker TMO, and Repligen, ticker RGEN.
Thermo Fisher, TMO, is the diversified giant in this space. They provide everything from the analytical instruments for quality control to the basic consumables for the whole workflow. Sanofi's increased manufacturing scale means more orders for TMO's filtration media, chromatography resins, everything. Their broad exposure ensures they capture value from any successful program.
And Repligen, RGEN, is more of a specialist, right? Focused on advanced filtration and purification.
Repligen is a pure-play supplier, deeply embedded in the high-growth parts of bioprocessing. Their products enhance the efficiency and purity of complex vaccines. Sanofi's intent to rapidly scale Heplisav-B and accelerate the Z1018 pipeline will mean strong, immediate demand for RGEN's specialized products. They are a very direct beneficiary.
Okay, so every major market move also creates headwinds for existing players. Let's turn our attention to who might face increased pressure because of Sanofi's strengthened position.
The first, and probably the most directly impacted group, is those facing what we call shingles category competitive pressure.
The pressure here is all about that early-stage candidate, Z1018. If Sanofi invests heavily to push that through the pipeline, how does that really ramp up the competition for an incumbent like GSK?
It increases the intensity on three fronts at once. First, pressure on securing favorable formulary status with insurance plans. Second, pressure on pricing. Sanofi might come in aggressively to gain share. And third, the competition for the attention of doctors and patients just becomes fierce. If Sanofi can offer a vaccine with a differentiated platform, maybe better tolerability, that's a credible threat that incumbents have to start defending against years in advance.
But GSK's Shingrix is a massive blockbuster product with incredible efficacy. Is a future candidate really enough to worry them right now?
That's the key question. Shingrix is a powerhouse, yes, efficacy over 90%. However, its administration is sometimes associated with high rates of injection site reactions and other side effects, which can discourage people from getting the second dose. If Sanofi's Z1018 using the Dynavax adjuvant can deliver similar efficacy but with a cleaner tolerability profile, it becomes a commercially superior product, even if it launches late. GSK now has to plan to defend against that.
The named incumbents here are GSK, that's the ADR ticker GSK, and Pfizer, ticker PFE.
GSK currently dominates the adult shingles market. The entry of a well-capitalized, aggressive competitor like Sanofi creates a direct, long-term threat. GSK will have to defend its market share through more complex contracting, bigger discounts, and investing more in real-world data to reinforce its own narrative. Their long-term revenue projections for Shingrix now have a new layer of uncertainty.
And Pfizer, PFE, they're also a major vaccine player with their own pipeline.
Pfizer faces challenges both in their own shingles pipeline and just in the broader adult immunization strategy. Sanofi's investment raises the bar for success. Pfizer now has to compete with a company that has explicitly bought technological differentiation and commercial certainty in hepatitis B, which gives Sanofi new leverage in all contract negotiations. It forces Pfizer to spend more to secure that prime formulary shelf space.
All right, the second category of players facing headwinds is the broader big pharma vaccine portfolio peers. This goes beyond just the shingles market.
That's right. The reasoning here is that a stronger, more focused Sanofi in adult vaccines introduces more commercial competition across the entire board. It's a portfolio-level effect.
So this affects everything from contract negotiations to product bundling. Can you give an example of how one acquisition impacts those broader tactics?
Sure. Think about the annual negotiation with a national health service or a major PBM. Before, a company like Merck might have offered a strong bundle with their pneumococcal and MMR vaccines. Now, Sanofi comes to that same negotiation with an equally strong bundle, but now it features a highly competitive, differentiated hepatitis B product. That makes Sanofi's entire portfolio offer more compelling, and it forces peers to lower their own pricing or restructure their own deals to stay competitive.
So it basically increases the cost of doing business and reduces margin flexibility for every other major competitor.
Precisely. It creates a tougher, more concentrated commercial landscape. Everyone has to defend their turf against an aggressive Sanofi that's trying to maximize the return on its $2.2 billion investment.
The companies you named here are Merck, ticker MRK, and Takeda, the ADR is TAK.
Merck, MRK, operates one of the most successful vaccine franchises in the world. Sanofi's new position means Merck will face direct commercial pressure, especially in positioning their non-flu adult vaccines. They'll face pressure on maintaining preferred formulary spots and winning major purchasing contracts.
And Takeda, TAK, they've been building their presence in specialized vaccines.
Takeda has been actively expanding their footprint, often in niche or specialized areas. Now they have to compete against a Sanofi that has dedicated massive capital to its adult strategy. Takeda will find that securing market access and getting attention from payers in this highly competitive adult market just got harder.
Okay, let's look at the final category of those facing new challenges, the smaller biotechs that are dependent on capital markets.
The reasoning here is that big pharma buyers, as shown by this deal, are showing a very clear preference for de-risked assets. They want companies with commercial certainty. They bought a company with an approved revenue-generating product.
And how does that preference for certainty affect the earlier stage, pre-revenue companies?
It leads to dramatically greater investor scrutiny. The demand for accelerated timelines for companies that haven't hit approval or commercial success goes way up. In an environment with higher interest rates, these early-stage companies need substantial proof of concept to get attention. If Big Pharma is spending its cash on late-stage assets, the venture capital and public market appetite for preclinical assets can really cool off.
It's essentially a market-wide flight to quality and commercial certainty in biotech investing, driven by what the buyers are signaling they want.
Exactly. The M&A market is telling us that companies need to hit major de-risking milestones before they can command a strategic premium. Promising science isn't enough anymore. You need a clear path to revenue.
The named companies here representing this segment are Inovio Pharmaceuticals, ticker INO, and Vir Biotechnology, VIR.
Inovio, INO, has a lot of vaccine candidates in development, often with cutting-edge DNA platforms. But they represent the type of company where investors might now demand much faster progress toward commercialization. They could face tougher questions in capital raises about their cash runway and market position relative to these accelerating big pharma pipelines.
And Vir Biotechnology, VIR, which has had success with partnerships but is in a very competitive space.
Vir, VIR, is another name whose valuation will be watched closely. Their success is often tied to clinical progress and partnerships. But in an environment where big pharma is consolidating, there's a risk that potential partners become buyers, focus on their own internal resources, which reduces the overall pool of buyers for external assets. This Sanofi deal just raises the investment bar for all earlier stage biotechs.
So this analysis really brings us back to the core signal from the Sanofi Dynavax deal. Big Pharma is prioritizing adult vaccine categories. They're seeking near-term revenue security and pipeline growth in these high-need areas. It's a calculated move to secure market position.
And it gives observers clear direction. We'd encourage you to watch for sympathy moves in other vaccine developers, particularly the ones we identified as potential M&A candidates, as the market adjusts their valuations. Also, you should anticipate competitive noise from the shingles and hepatitis B incumbents as their strategic planning for 2026 starts to ramp up. The commercial battles are just beginning.
This one transaction really is defining competitive strategy for the major vaccine franchises over the next few years. It's definitely one to follow closely.
Thank you for joining us.
It is important to note that this is not financial advice or buy or sell recommendations. This is purely the opinion of the author. Thank you for joining us for Breaking News to Trading Moves.